Good morning, fundamental trends, and a little bit of seeking alpha. Tuesday, June 16th, 2020, and apparently the world is going to recover in a V shape because now we're only 7% shrunken economy compared to last year. So this morning, Bloomberg put up the numbers that there was a sharp rebound in retail buying in May and construction permits and some other things in May when the economy reopened. I think that makes a lot of sense. From closed to open, you would expect a bit of a rebound. So the expected numbers were blown through because nobody knew what to expect. So we're getting a pretty nice rally this morning. If you saw on the chat board last night, I was playing with charts and I said it looks like we can have a pretty quick rally, as in this week, back up to 319 or 320 on SPY. And this big jump this morning makes it look like that could happen. So what we're going to do today is just take a look at a couple of things for perspective, give you a Twitter feed that I think you should follow, and then we will play with some charts. So let's start with Harry Dunn. Now, Harry Dunn is an independent analyst. He's on Twitter at HarryDunn88, and I'm pretty impressed with him. I don't know that I would pay for the service. I currently do, but he puts enough of his stuff on Twitter that I could probably fill in the gaps for you. So I would just follow him on Twitter. Plus, you have to pay the gateway fee over at Avi Gilbert's site. You got to pay Avi his $100 a month so that you can pay this guy $30 a month for just a Saturday afternoon report that really you can get similar stuff from 50 other people that are just trying to get some PR. So, an interesting macro perspective. I've been talking about this, how all the economic numbers fell off a cliff. And they're starting to come back now. But look at how far back these numbers have to come. This line, this is all we could do by reopening. Think that through. This was closing. This was reopening. Not equivalent. Big jump, but not equivalent. So for us to get back to the point where GDP and operating earnings are back up here, I'm guessing it's going to take to at least 2022, but I think 2023. And I think the question we have to ask is, at what point, if the economy is getting better, does the Fed back off? Well, we've looked at the numbers. We know the Fed is actually already backing off. But buying individual bonds. Yeah, sure, but that's not new money. That was money that was already allocated. We already knew that was going to buy bonds. The difference is that they're going to create their own index versus buying ETFs. Why is that important? It allows them to buy the companies they want. So they could say that they're not going to buy oil bonds, but maybe they are. Or maybe they were buying certain bonds through the ETFs that they don't want to buy anymore. It could go either way. So with the bonds, I did send out a note today. If you still own the high yield bond fund, the iShares HYG, I think that today is a fantastic day to trim it or get rid of it outright. There maybe is 4 or 5% upside left based on what those bonds would mature at. But I think it would take a really long time to get that. And if we get another stock market correction, those bonds will get hit. And you have to remember, the high yield bonds aren't getting Fed money. The high grade bonds are, and the fallen angels are. So about 60 to 70% of the iShares HYG gets no direct Fed support. So if you're going to be in some of these bonds, I suggest Angel, ANGL, which is the Fallen Angels Fund, because that gets a lot of direct Fed support. So sell HYG today, and at least some of it. I've sold all of mine as of this morning. And with Angel, I think you can hold on to it if you have it. I think you can buy it on pullbacks. Again, because the Fed is giving it direct money. So going back to this chart, the last time this happened took 6 years for the stock market to recover, 2 times ago. And then this time, 3 years to recover. And as steep of a drop, and really it started in early 2018, which I've been telling you about. You know, this economy has been turning over for a while. Fed starts printing money around Labor Day, gets a pop, coronavirus gets a drop. And the question that everybody's asking is, well, if the Fed keeps printing money, will that bring the economy back? No, because people are still not doing all the things and buying all the things and doing all the traveling and all the going out. They're not doing all the things that they were doing. So even if that's only a 10% decrease by the end of the year, right? Let's say we come all the way back to within 10%, that's still 10% lower GDP. That's probably where we're going to end up, somewhere between a 10 and 15% GDP hit this year. So the idea that the stock market should reflect full value, which was already overvalued up here, I think is pretty misplaced. How high can it go? I don't know. The Fed is only allowed to allocate so much money. They have rules on what they can buy. They're not allowed to go out and buy stocks. That's a law. I don't see the Congress changing that. I think that the Democrats would rather do many different things than allow the Federal Reserve to buy stocks. So I would say that that's a 0 probability or a 1% probability. And with the Fed tapering down, I think that the hopium rallies are going to start getting weaker and weaker and weaker until this turns over. Volatility has come down. What does that look like? Even with an eyeball there. What does that look like? What does this look like? Come on. What does that look like? God damn it right, alligator jaws. All right. What do we know? Those always close. How fast? We don't know that, but they always close. Had one over here, closed. Had one over here, closed. They always close. So this one is 100% just about dependent on fake narratives and Federal Reserve money, because we, if you were paying attention, learned this week that the first vaccines, which could be out this year, won't actually prevent coronavirus, may not even keep you from getting sick. It'll just keep you from dying. Might still end up in the hospital. So the better vaccines just certainly don't look like they'll be around until next year. We also see all the coronavirus numbers going up. Houston's talking about shutting down again. China's shutting down cities again. What happened the last time China shut down cities? Disrupted supply chains, disrupted demand, global demand. If global demand is lower, that's bad for us. So we export, and our supply chains get disrupted. So we have to be real careful about buying into these positive narratives because they're probably not true. I've talked to you for years about how traders will spin a narrative to support their trade. And I think that's what's going on now. So I am looking for things to short. So using my trusty, lovable stock rover, I am screening. This screen is all the S&P 500 dividend payers. Okay. And you'll notice I did this little article, I don't know, whenever I did it, last week. And I listed a bunch of properties that I thought would cut dividends. Turns out that Royal Caribbean did a couple weeks. I missed it. So I was right, just didn't know I was right. So Royal Caribbean cut their dividends. And I put some properties on here that I think will probably cut dividends in the next year or so. And people gave me a hard time about the banks. But why would banks cut their dividend? What do banks make that may not get repaid? Or may get repaid slower or not in full, right? Loans. So if car loans start to go bad because people are out of work, especially people who had a nice job and they lost it, right? What if people who were only making 40 or 50 grand a year, but because they had a 700 credit score, they went out and bought a $40,000 car. And now they can't make as much money tending bar or waitressing or whatever it was they were doing, right? People do that. People overspend not only their income, but their job security all the time. Why? Because it makes them feel good. So if cars start getting taken and homes start getting taken, the banks are in trouble. But capital requirements, but Dodd-Frank, but they have lots of money. Yeah. But they're leveraged 6, 7, and 10 to 1. It doesn't take a lot of bad loans to wipe out. Screw Ian. It doesn't take a lot of bad loans to wipe out the free cash flow of a bank. And for the Fed to have to help them out. Well, if the Fed helps out the banks, what has been the condition of doing that in the last decade? You have to end your buybacks and cut dividends. Well, they've already cut their buybacks. So stocks that were going up on the back of buybacks, right, aren't doing buybacks anymore. Did anybody you know talk about a buyback bubble ending badly someday? Right? I warned you 2 years ago. When the buybacks disappear, stock market's in trouble. So right now, the Fed is taking the place of the buybacks, kinda. They're bailing out the bond market. That frees up some cash in the economy. The rich people, I've shown you the charts, aren't buying stocks. The hedge funds actually have, in the last couple of weeks, been trading the stock market on the bullish side. What do we know about hedge funds? Hedge funds can change on a dime. They just did. They went from net short to net long. What do you want to bet that they're net short again soon? Right? I think that this is the biggest rope-a-dope that we've ever seen. So you've got the Federal Reserve putting the pedal down and slowly lifting it up. Right? I mean, they've cut what they were putting into the market by 90% already. Think that through. Huge dump of money. I showed you on Friday's webinar. Huge dump of money into the market in March. And then they've been tapering it off. Interest rates actually have risen. Fed hasn't risen interest rates, but the markets have adjusted. A lot of people around the world are getting irritated with the dollar. So the dollar was temporarily oversold in the last couple of weeks. I think it's still temporarily oversold. And at some point, if there's a shock or just disappointment, right? Disappointment in new expectations. What happened today resets expectations higher, makes them harder to meet. We know that coming off the bottom, you're probably getting your biggest pop. Going into summer, you're probably going to have, people walking around and being outside. But what happens when it's not so pleasant to be outside, right? So think this stuff through. Think about what you're doing with your kids right now or with your family right now. Is it the same as last year or is it different? Is it more or is it less? That 90% of the people are spending less money, doing less things, buying less stuff. There is a little bit of pent-up demand. That's why I think retail sales are up in the last month. People didn't shop for a month and they're like, oh my God, I need new shoes. A couple t-shirts for summer, right? So all the numbers that I've looked at, chart after chart after chart, just makes me think, this is not going to be a V-shaped recovery. The market still says that it could be. The market's wrong. So if you want to look for stocks to short, I suggest stocks that might cut their dividend and that are overvalued, overbought, or approaching overbought. Corning. I think Corning's a pretty good one to look at shorting, buying puts on. Invesco already got its ass kicked. I don't know enough about realty income to tell you one way or the other. But if we take a look at their dividends, how easy it is to use this to sort. You could take a look at some of these. It's like Health Peak Properties I'm wondering about. Their FFO and their dividend per share are getting pretty close. What do we know about the healthcare REITs? Seriously, what do we know about the healthcare REITs? We know that a lot of them have senior living, assisted living, and nursing homes. And we know that a lot of those offices have been closed. And we know that a lot of doctors are practicing differently now, to the point where a lot of these clinics and offices might not command as high rents in the future. Why? Fewer staff, right? So I don't know to what extent teledoctoring is going to impact this, but I had one doctor who just jumped on board as a consulting client tell me that he switched jobs because of it. So, the world of healthcare is changing. Again, the old narrative on healthcare was, look at all the aging baby boomers, we better have lots of healthcare, and healthcare stocks are going to go up forever. I've already told you I don't think anybody's going to make money on the coronavirus vaccine. Maybe one or two or three. And those stocks are all bid up. Why? Because you're going to have to be able to give it to people for $20. You're not going to be able to sell it for $100 or $200 a dose. It's Medicare is only going to pay you so much. And that's going to be one of the biggest distributors is Medicare. Probably, and Medicaid. So 20 to 30% of all of them are going to be almost profitless. So the liability on Ventus, which I talked about in this article that people said I'm full of shit on, And I've learned that when people tell me I'm full of shit, I should usually double down, because I end up being right 80-90% of the time. You know, Ventus has some pretty big risk with the assisted living and the nursing homes. What day does some lawyer say we're suing Ventus? It's soon. I'm telling you, it's soon. I've checked into 3 different nursing homes and assisted living facilities, plus my grandmother's, in the last month or so. And there's one in Milwaukee where 60% of the people got COVID. 24 people died. None of them got reported as COVID deaths. So now a newspaper is looking into it. There's a lot of that out there. So is Ventus guilty of anything? I'm not saying that. But I'm saying that, one, their dividend was threatened without COVID. And now they have all those COVID risks. So Ventus is one that we're going to look at. I didn't put this on my list. Actually, I think I did. Yeah, I did, Oniac. So we're going to take a look at Oniac and Exxon, and a couple others. So let's start with Simon Property. When you're doing a short, just draw your basic Fibonacci's, right? Recent high to recent low. Easy. You can do that. Now that's called a Fibonacci retracement. Now we want to do a trend extension tool. So what you're looking for is a swing high to a swing low, back to a high, or a swing low to a swing high to a low. So low, high, low, or high, low, high. It doesn't matter. So I would say this is something we could look at. It's a high point. It's that low. Back to that high. And I'm going to move this chart. Put my lines from the same spots. Just matching them up because they both go to the same high. There you go. Now, so that pulled up some Fibonacci retracement. So this is expecting the extension of a down trend, right? This is the extension. Boom. So it puts in your fib lines. Look where Simon got to. Right at a support level. Now, we didn't know what this one was going to be before, right? Didn't know that until it happened. This one projected the downturn because it was the extension of this downturn. Rebound rally, right? Just like Elliott waves. And then down here. And look where it jitterbugged. Jitterbugged right at a fib line. So now here's the question. How high does this rally? Well, it almost got up to this pot here, right? I think, it could get up to around 105, 106. Or, now that it broke down, I think you're dependent on the dividend announcement. And more importantly, I think institutional investors will be looking at the redevelopment announcements. How much is it going to cost Simon? So Simon canceled their deal with Tubman because it just didn't make sense. And I think they realized, my God, we've really got to we can't just remodel a mall anymore. Most of the malls in America have to be completely made over. Completely. The kiosks that are highly profitable in the walking areas are probably going to be gone to a large extent because they're going to want more space. They're going to have to put in better filtration. They're probably going to put in UV lighting filters. There's money to be spent there. They probably are going to have to change who their tenant base is. The big box stores are closing. Amazon's not going to buy them all or occupy them all. Amazon likes to own their own buildings. So who's going to go into the JCPenney's that are closing, and the Sears that have been closing, and Macy's and Nordstrom? Who's going into all those boxes? I don't know. I suspect that they try to turn them into a different commercial use, like going to a corporation saying, hey, how would you like to have yourself kind of a shared campus? And they start sticking companies in those big boxes. They set up their own office structure in there. They're nice high ceilings, right? They set up offices. They have an entrance out into the mall so people can go and eat, walk to eat, you know. Maybe your laundry places pop up in there, your dry cleaners. So I think there's a major restructuring of malls coming because the box stores are just gone. So what does that do to this stock? Well, it might be in the middle right here. Got all the way up to 96. Instead, closed it on that fib level. Started to drop, and now it's jitterbugging at this fib level. So could we put in another line? I guess. I'm not really sure which one it would be. I mean, maybe we continue this as a pivot low. That pivot all the way back down. And son of a gun, look at that. When you draw the next fib levels, you say, look at that, it got really changed direction right near that one. So which fib levels do you use for Simon? It's a hard question. Do you use the older pink or the newer purple? In general, you're going to use the newer, right? So when it fell, that was represented by the pink. Don't need it anymore. Now we have the continuation, and we're wondering, is it going to continue down? Hard to know. I would suspect that Simon breaks through this level here, heads all the way down to where they were long time ago, right? In the 30s. Why? Because their rents are going to go down, their expenses are going to go up. Period. It's that simple. There's going to be less rent collection and higher expenses for years, 2 years at least, maybe 3 or 4. So the question is where do you short this? It looks like you just had your chance. So now it's retracing back up. I'd say right around $80 is probably where you can buy some puts. So let this rally play out. Keep an eye on these in here. You know, what does RSI isn't quite to where you want it, right? But it got there. Let RSI get up there. Take a look at your MACD, right? Looks like it wants to turn over, but now it's, you know, maybe it's going to turn, maybe that blue line is going to turn up just for a second or flatten out. Not going to quite go through right away, right? So you're really close to buying puts on Simon. So if you that's interesting to you, keep track of it. Don't wait for me to send you a note. Hey, I'm shorting Simon. Yeah, I will, but I might not do it. That doesn't mean you shouldn't. You can pick out your own trades. So I just want to lay out that I think this one's pretty interesting for a small amount of money to speculate on them heading down $30 or $40 a share. And because of all those dividend investors, I bet you can get the puts pretty sharp, pretty cheap. Let's take a look over at NASDAQ. Your option chains for Simon Property. Say October. Don't want to pay for too much time value. And let's see here. $70 puts are only 10 bucks. Probably should just use Yahoo, huh? Yahoo's actually pretty good at that. And it's started to give some back. We'll see. We'll look at that in a minute. Let's pick out a stock. Options. 77. So there is some pessimism in this name, right? So I'm thinking 10-ish bucks for the 70s. At 60 you're even. 50 you double your money. 40 you triple your money. What would be even better is if this goes up another couple of dollars, right? And then you can buy a higher strike price with about the same premium. So what I just did there to figure out whether I was going to win or lose, just pretend that there's no time value at the end or when you're getting rid of this. Say, okay, I'm going to spend $10 on this. 60 makes me even. 50, I double my money. What do I think the odds are that I get to double my money? Right? It's not worth more than a 1% or 2% bet. But, you know, if you make 10 of these and you're right 5, you know, you're even if they all drop to there. But if a few of them really fall through the floor, right, that's how you short. So if you're really going to try to short the market, not just hedge, you have to understand the risks. You have to sit here and do math, paper and pencil. Some other companies that I think are ripe for shorting. Look at the rally off the bottom here for Exxon. I've said that I think Exxon is going to 20. And I think it's going to happen a lot faster than people think. Here, we'll take a look at the Januaries. And I'm just getting used to these right now. Exxon's probably going to rally, and it might even rally through whenever it becomes apparent that Biden will be the next president. So when does the market adjust to a new president? When it's completely convinced that it's going to happen. Right now, because of what happened in 2016, people don't want to count Trump out. The Economist just put a pretty interesting chart up. They have it at like 10% that Trump will win, which is what I've been saying for a year and a half, 2 years now. Exxon at around 50 bucks a share. If you bought the 40s, you'd only be paying about 3.5 bucks for them. That's a pretty good deal, right? It's way cheaper, right? Less than 10%, about 7%, versus the Simon ones, which had a lot of pessimism baked in. So one of the tricks to buying puts is if you've got a good thesis, and nobody else is on it yet, right? You're going to get your, it's cheaper to short. One of the reasons why buying puts is so hard is because once other people are on the same thesis, they get expensive. It's very expensive to short in most cases. You generally need to buy the insurance when everybody least thinks that you need it. Betting on the heart attack, betting on, right, the cancer, betting on the car accident, right before it happens. So that's why it's hard to do. I told you I talked to a guy named Bob Savage last year at the Traders Convention in New York, and he said, people think that hedging will make your money, but the reality is, unless you hit a home run, hedging is really just incremental improvement in your portfolio, making a few points when everybody else loses a bunch. The best hedge is always cash. Why? It's cheap. So you say, well, I'd rather hedge my portfolio with puts. Puts aren't cheap. Margin's not cheap if you're going to short. So cash is a great hedge because it's free. And in fact, you might even collect 1% on your money or 2% on your money versus paying 7 or 10 or 15% to hedge, right? It's like using a credit card to pay your living expenses and not paying it off at the end of the month. So hedging is hard and it's expensive. So we need to look for ideas where the options are still cheap. I think Exxon on this rally is where you might nibble in a little bit on an Exxon put to January, because we don't know if there'll be a war in the Middle East this fall, in which case all these stocks go up temporarily. So I'm almost, because I manage retail accounts, I can't really buy these puts. They're too risky. But in my account, I can look at these. And to me, if Exxon goes up more, they become even more attractive. So here's the thing with Exxon. Finding the pivot point is hard because the damn thing's been going over a long time, going down a long time. So those are just general fib levels, high to low, right? The retracements. The extension is, where do you consider this to have started? I mean, clearly that's a pivot up here. Fell, pivoted up, pivoted down. So what is the extension? Start here. I bet that what this is going to show is about where it got to. So look at that. Broke through this Fibonacci level down here, pretty quickly reversed. So that's the big one. That told us about where it could get to. So let's get rid of it and do something more frequent, more recent, I mean. So we'll do this one. Actually, this one, high, low, to high. There we go. That's what we want. So now it's come back up, gone through 1.68, which is a common one. Came back, went through it, came back to it. So this represents both some support and some resistance. It got through that resistance, came back. I would think that this area here, up around 60, see how the line breaks and jitterbugs? this area right in here is going to be pretty strong resistance. So I'll use the orange lines for resistance to short from. So I don't think it's, you know, it could be. I mean, you need bad news for it to go down. I think you might get more hopium rally here. So I don't like this one because it's in the middle. This looks more structural to me, especially when you look back. Oops, weekly chart. I meant the weekly chart. Grr. There you go. Right? If you look back far enough, you see, hey, look at that level. Just happens to be in line with all this stuff back here. So I like using these longer term structural things because I think that shows you the broader idea of what the structure is of this stock. Was this reality? Right? Or is this reality? I think this is reality. Right? This was the shale boom and 9/11 crash. But this is all the oil's going to be expensive for a long time crowd. And now we know that's not true. So this range is probably about right. And we're kind of at the top of it. But I think that we can get to the bottom of this range. So think about this, right? So look at that. Kind of right on top of that fib line. There's a fib line there. This area right in here is pretty structural when it comes to being the floor for an old range. And the ceiling, and really the ceiling might even be lower. This is kind of a gap area, right? That gap right there. So will we refill it to the upside? Maybe. It's a hard trade from here. I think it's a much easier trade if this gets up to around here. I think it bounces off these levels and comes back down. In fact, I would probably start shorting right before that fib line. So I think the odds of breaking through this area is pretty slim. So let's save that. We'll put that on the VSL, which I have somewhere. Put that right into the VSL. These guys still on? Yeah, these guys are still on here. There you go. There's a chart for Exxon. All right. So we'll take a look at just one more that I had in the article. Take a look at these guys. I don't want to erase these, but we'll walk through it. All right, so you have your big fibs that go way back here. Start of, I used the 2016 low rather than the 2015 low, just because I want they're usually a little higher, so it gives me a little margin of error. But I'm keying everything off the Trump presidency because that was the major change in policy. That was the tax breaks and then the luck of the cheap oil. This fib level here sets out our green bars. And this is a bottom, top, bottom. And how close it got to that fib level. And now look where it's going. It's gone all the way up to this fib level, Corning, 0.5. But the 0.618 is the popular one. So then let's take a look at a shorter term time frame. Swings, swing bottom, swing high, bottom. And it blasted through this level. And clearly it's using pink lines. Voila. Now you can draw other lines, right? You can create what you want and see what's working. So sometimes you're backfilling. Okay, this is where it went. What is the structure that it is implying? So, I mean, this really could turn back down right here. I wouldn't start buying puts until it gets right up, you know, to 29 with a 29 handle. Because with a 29 handle, I think you're getting into this structural area. Right, look at that structural area right there. All the times it went through these prices. And the battle is, does it want to be below this level or above that level? I think it's going to want to be below this level at some point. So here's another one. Right? Battle zone is going to be above or below this area. I think below. So there you go. There's another one. Corning. I don't think this is on any list. And I don't want to put it on the VSL. I just gave you the link. And I will write a Swinging for the Fences article with all these charts. And I'll put a few more in. But I don't think we're quite to the short area yet. It might be tomorrow or a day after. Right? It might happen that quick. But I think Corning at a 29 something, you can probably buy a couple puts. Exxon, I'd wait till around 60. Simon, right? I think back up near 90, right? It tried and then it couldn't. So Simon around 90, you can buy puts. You can look for your own ideas. I don't know what you could do for free on Stock Rover. If you just don't get as many of these things up here, maybe. But the screening is really good. So if you want screening, there you go. Banks, you know, Wells Fargo. I think Wells Fargo is probably, I think there's too much baked into it, maybe. See, Wells Fargo hasn't done much in the way of rebounding. I mean, does it have another leg down? I guess it could. With all this support ahead of the problems, I don't know. I think most of the price decline in Wells Fargo is baked in. If you were going to buy puts on them, I think you look at January with these guys too. Yeah, these aren't cheap, right? They're not cheap. They're over 10%. 10% is kind of a demarcation line. It's just easy to think in tens, right? There you go. All right, does anybody have any charts you want me to pull up for you? Did it help that I went through how to do those Fibonacci extensions? Oh yeah, I have GDX up here, don't I? Did you understand the Fibonacci extensions versus the retracements? Retracement doesn't take into consideration a trend, right? So with this one, we have the lines, you know, we're going way back, some big things. And the trend is up. So doom, doom, right? Bottom to top to bottom. Give us our levels up here. Come on, baby. There we go. That's what I wanted. So here it does. It's come down, and it just doesn't want to go through this 32 and change price area, right? It bounces off everything, you know, 3 times now in the last week. So if we there, 3 times, let's hit that level in a week. That almost always means it's going to go through it, right? 3 tests, 2 tests, you bounce up, make the W. 3 tests, no letter for that, right? So down, up, should have broken out, it didn't. Actually, it's 4 times. Yeah. I wonder if that counts as 1. Probably. Once, twice, 3 times. Normally this will come down. So I'm saying that if GDX gets a 29 handle, right? 29 handle, I think for sure start selling puts. If you don't have a position, I think nibble. And I don't think it gets much lower than middle 20s. And I think that would have to be as part of a pretty significant correction. Yeah, it was at 31 for a minute, so right there, right? Yeah, right there for a minute. Intraday. So didn't finish the day there, but yeah, if you look at the 4-hour chart, yeah, you get a lower right there. June 5th. But it's been hanging out in this area, right? The day traders keep pulling it back. I mean, that is, look at that. Hugging that area. Doesn't want to come down, but I think it's going to. I think that this yellow line, see this? Test comes through, bounces off, down area, gets back to it, jitterbugs, and then gets to a higher area. I think it tests this area here, 29s. I don't think that I am going to wait to do much once it gets down to 29-ish. Once it has a 29 handle, I think I'm doing something. Selling puts for me. I know some people sold some puts and got some pretty good prices. I might even look right now. Should we look right now? Let's look right now. This is only for people who have done this before. You're not allowed to do this if you haven't done it before. So if you want to do it, learn how by using a practice account. So right now, if you sold a 29 to September, you get $1.30. Meh, that's not sexy enough for me. I want to be able to sell a 29 for like $4, $5. I want some volatility to the downside. I always said volatility's gotten low pretty quick. Don't think the Fed can hold it off forever. So unless you think we're in a bull market, I don't think I'd buy just yet. Let it come down to here, then create a spring for you. So 29s. All right, anything else? Kirkland. Let's get rid of these. All right, he wants Kirkland. Fib retracement. Call that the low. Call it the high. Kind of like that because look how it hit that one right there. Sometimes you get lucky and it ends up being right the first time you try. Well, we could go all the way back here. It's hard when a stock first starts trading because what's real here? I like this because it's the first major pullback. All right. So pivot high, bottom. This actually looks like a bearish chart in the short term. Like it was overdone in here. That really doesn't look too sexy to me. Shoulder, head, shoulder. That'd be bad. It's not a sexy chart. Pivot low. High. Retest. All right, that makes it look sexier. I don't know. Look at that, it's right at that support level though. Next one's way down here. If you are truly bullish on this company and you understand why you can be bullish, and you want a bullish argument, your bullish argument is that it looks like it could ricochet off of here. This is where shaking money flow probably comes in handy. Yeah. There's no sustained. That sucks. Yeah, look at that. I don't like that at all, man. It's just, I have a hard time with this one. To invest in this one, you have to know something the rest of the world doesn't, that the rest of the world's willing to jump on. I'm telling you, Newmont Mining is the one because they're in the S&P 500. Look. That's much better money flow, right? So I think you're much better buying Newmont. I mean, that's a much more defined uptrend. I think you're way better buying Newmont than Kirkland. I think Kirkland blew its wad, so to speak. Good mine. I know all about their mine. But the stock just doesn't look that sexy. You'd really have to have a strong argument to buy it here. Okay, we'll finish off with IWM. We can even start over. All right, so I'm going to be comfortable and say that the long-term lines are right. So 2 sets of Fibonacci's for just your general retracements. Keying off of the absolute low at the start of 2009, and then the 2016 low. Again, I think the 2016 lows are the bear target. I mean, this stuff going back over a decade, like I said, I don't think Armageddon's that likely, but I think it's just as likely as a continued bull market. So we want to find a significant pivot. Start with the super long one. Go all the way to the top. I just want to show you how high IWM could get, right? If this bull market continues after some jitterbugging around in here, you're looking way up here at 240. And you're probably talking literally 5 years out, 4 or 5 years out. Okay, so let's look at a shorter term one. Let's go to the daily chart and say, okay, we know that the upside is pretty high in the long term. That doesn't always work for me. Oh, look at that. Jerks. All right, so let's take a daily extension. And our idea is that this is a trend lower. Get that pivot low to this high, pivot high, to that pivot low. I did that backwards. Try this one. There we go. High to low to high when you think it's a downtrend, low to high to low when you think it's an uptrend. All right. And let's make that purple so we understand it. So, right, your Armageddon scenario. It's way down here, actually. 40. Oh, Christ almighty. Would that just blow your mind? What does that even go back to? Yeah, that'd be all the way back to 2001. That's not possible. In the words of The Simpsons, that's impossible. I like that. Look at those 2 Fibonacci levels. I'm saying that's Armageddon, not that. I don't even know what you do. That's a collapse of the entire world. All right, so had this fall off in March. Pretty strong rally. I think there's a pretty strong fundamental analysis for small caps, right? I said that over the last year. I thought that you'd get a small company boom in the 2020s as we got better healthcare policy and millennials want to do their own thing. What's this? center line. Okay. So right here, couple levels, confluence here. It's working its way up through the wall of worry. So I'd say your line that you short at, probably about there. Low 150s. And we touched it, came off, hits it again. I think that's where you buy your, that's just crap. It looks like crap. There, make it easier to look at. Here. Yeah, I think, see how it gets through this wall of worry? It's climbing these like stairs. And then here, either has to break out to back to the highs or turn back down. So 153 handle, I think you can start buying puts, right? That makes sense? Are you guys seeing what I'm seeing? And girls, are you seeing what I'm seeing? Anybody? No? Are you lost? Do you have Migo? My eyes glaze over? A little lost. Do you understand the Fibonacci's? You understand that you're just setting up zones, and then you notice that they retrace to those areas a lot of times. And you have to understand, are you looking for an extension? Are you extending a downside or extending the upside, right? As an extension. So here is a big gap, no Fibonacci levels. And that means that it either has to break out or turn back. And it's climbing all these different Fibonacci levels. Purple being the shortest term extension, pink being a longer, the main wave extension. So I think you can buy puts at the orange, and then I take profits for sure, as you get through these zones. Maybe take some profit here, take some profit here, and get rid of all of it here. Change this back to a weekly chart. Where's 2001? All right, that gives people some perspective. Okay, so I will publish this one too. If you've been noticing, I've been putting in links. All right, last one will be end phase. We just invested all of our money in it down here, right, when we talked about it. We'd all be in Vegas. We own it. So a continuation of the uptrend. You're looking way up here at 90. There we go. Now we can do that. There. I'll just use a daily chart. Yeah. There you go. I like that better. So here's your basic fibs, shorter term fibs, low to high to low, extension going up. You do another high low. You could do another one if you wanted to. If you think that's a low, I'm not ready to call that a low. I mean, it hit a very important 0.618 right there. And it was on top of the long-term fib. So this 48-ish price level, maybe that's it. Look how it tests right there, comes back and then breaks through. Comes down here, retests. So if the market doesn't get bearish, right, if we're in a bull market, it probably holds this level. I don't think we're in a bull market. Excuse me, I meant bull market. If we're in a bull market, it probably holds the 48 area. If we're gonna get back into a bear market, I think that this level down here makes a lot of sense. Really, anywhere in there, I think makes a ton of sense. But if you're, I mean, I guess we could move it up there. If you're a bull, and you don't want to fart around to $5 or $6 or $7. I mean, I think the other day I told people to go ahead and sell some puts when it got down at 48. I don't know if anybody did. But yeah, you can sell puts at 48 for sure, right? Because you don't know if it's going to break through or not. I mean, that's where you come and look at these and you say, okay, RSI is heading up. I think at some point it gets really overbought. Let's finish with shaken money flow. When shaken money flow is low, what two things can happen? It indicates, oh, you sold the $40 puts? Yeah, I think you got like 6 or 7. You got a lot of money for those, didn't you? Yeah. So it was she got a good deal. You know, it's high volatility that day, right? So when shaken money flow is low, that means either you're heading into a correction or in a correction, or it's just going to be choppy. So with a stock that you're bearish on, generally it's going to go down in price when shaken money flow flows off. On a stock that you're bullish on, when shaken money flow goes down, just means it's generally going to be choppy. Because stocks in uptrends generally don't give up a lot when the money's coming out. It just chops along. It consolidates. And then the money comes back in and it pushes it up. Right? If you think of every stock with 4 different scenarios, bullish, bearish, money going in, money coming out, right? It ends up being pretty easy to think about. Just create quads for your thought process. Hedgeye does that. I read them all the time. Think of everything in quads. Where are we? Are we on a bullish side or the bearish side? So money going in is money going out. That sounds like a good chart for me to put together, doesn't it? All right, we're gonna call it a day. It's been over an hour. I'm going to announce the Book of the Month Club in the next week. And the first book is going to be a pretty well-renowned technical trading book. And then the August book is going to be a how to actually learn fundamentals. So we're going to have 2 books, technicals and then fundamentals to start. And then we'll figure out what we want to read in the autumn. All right, have a great day. I have people coming over to use my pool in a couple hours, so have to shower up and get ready. Take care, everybody. Have a great rest of the week, and mind those levels that I put out there. And I'll throw together an article today at the end of the day when the charts are updated, and give you some ideas. All right, take it easy. Bye.